Ladies and gentlemen, you are all welcome to my channel The Accountant. Today we will learn the principles of accounting. Please you can learn, like and subscribe to my channel for more videos concerning accounting. Accounting principles are uniform practices that entities follow to record, prepare and present financial statements. An entity must prepare its financial statements as per acceptable accounting principles in order to present a true and fair view of the state of affairs of the entity. Uniform accounting principles assist in the comparison of financial statements of entities. If the accounting principles followed are the same, then the reader of financial statements can compare the financial results of two entities. Benefits of accounting principles given in Accounting Standards or Indian Accounting Standards, Ind AS. 1. Recognition of an item as income, expense, asset, or liability. 2. At what amount it shall be recognized in the books of accounts, and 3. How to present these items in the statement of P&L or balance sheet. 4. It also provides all disclosures are required to be made with respect to the items recognized. Accounting principles guide entities on preparation and presentation of financial statements. It reduces the inconsistencies, presents true and fair view of state of affairs and makes comparison easier. Key accounting principles are: accrual principle. This is the concept that accounting transactions should be recorded in the accounting periods when they actually occur, rather than in the periods when there are cash flows associated with them. Conservative principle. This is the concept that you should record expenses and liabilities as soon as possible, but to record revenues and assets only when you are sure that they will occur. Consistency principle. This is the concept that, once you adopt an accounting principle or method, you should continue to use it until a demonstrably better principle or method comes along. Going concern principle. As per this concept, an entity has an intention to continue its operation for the foreseeable future. Matching principle. The matching principle states that expenses should be recognized and recorded when those expenses can be matched with the revenues derived from incurring those expenses. Revenue recognition principle. As per this principle, revenue should be recognized when they are and not when the amount is received. These principles are clearly given in Accounting Standard 9, Revenue Recognition. Accounting principles are different from accounting policies. Per se, accounting principles are broader than accounting policies. The accounting principle has been defined above. Accounting policies are accounting principles used in preparing, presenting, and disclosing one specific item. For instance, depreciation is an accounting principle of amortizing the amount of tangible asset. Now depreciation can be charged by straight-line method, SLM, written down value, WDV, method, etc. Depreciation of tangible assets is an accounting principle, whereas following SLM method for depreciation is an accounting policy. An entity incurred an expense on the purchase of machinery, whose benefit entity will have for the next 5 years. In such a case, the entire expense should not be charged in the first year. It will be matched with the benefits derived from such asset over 5 years. Now, the entity can either follow a policy to charge depreciation at straight-line method, SLM, or written down value, WDV.